Good morning. I go by Digital Oil Hunter, and this is an episode about the history, the future of equity crowdfunding, and how it impacts you as a regular individual investor. I want to tell you a quick story, dive in some factual details, and then present to you a very comprehensive information about where we've gone, where we're headed, and what that means for you. I have a bit of a script here, so don't mind me while I read from it, but I want to make sure that this is information that is accurately presented. That's why I'm using a script. In 1995, Oscar Joffrey founded the Babelfish Corporation, a free, web-based, multilingual translation application. In 2012, it was replaced by Bing Translator, which is now Microsoft Translator. In the early days of the internet, it was primarily written in English. Oscar wanted to help democratize access and give individuals across the globe the ability to translate and use the web. Among other endeavors, Oscar directed his passion to help the underserved to the private markets. He started working with a gentleman named David Wield, who was the former vice chairman of the NASDAQ, and he spent 10 plus years trying to solve the problems he saw in the private markets, eventually authoring the Jobs Act. This was an acronym short for Jumpstart Our Business Startups Act. This bipartisan act was signed in 2012 to ease the regulations of private companies, enabling them to seek capital directly from individual accredited and non-accredited investors for fundraising. Quick side note, if you're unfamiliar with these terms, real quickly, the accredited investor status is for people who have earned over $200,000 in salary consecutively for the past 2 years and or have a net worth of over $1 million without including their primary residence. Non-accredited investors are everyone else below these earnings. Now, before this act was signed and later leveraged, people only had the visibility to 1,000 privately held companies, while every year 145,000 private companies are raising capital. Now, this might blow your mind. This was only visible to venture capitalist types. Even though 145,000 private companies were raising capital, only about 1,000 of them were visible to these VC types. And do you know how many were visible or accessible to individuals like you and I? Exactly 0. Contrast that today in 2022, where you had $151 billion raised by private companies from nearly 15 million regular, non-accredited American investors like you and I. This stark contrast was made possible by the efforts of people like Oscar and David to democratize equity crowdfunding. Now, let us take a step back and add color to this amazing feat to help us further understand the impact of this achievement. Then we can discuss the innovative developments that spark an even greater future for investors like you and me. Oscar Joffrey was laughed at on stages back in 2012 by some of the venture capitalists he was speaking to. Why? For 2 very important reasons we need to understand. Firstly, many have long believed that venture capitalists were using their own money, but it was not their money. It was your money. You put your hard-earned money in some fund, or it was placed there on your behalf in the example of a pension fund, and it funnels from fund to fund, absorbing fees along the way, and then you end up happy with an 8% return. Meanwhile, the VCs are getting 2% of the total fund whether they do well or not, another 20% of the profit they earn from the carried interest, and overall, they were walking away bringing in 300% returns on the override. And you were never going to be let in on that until something like the Jobs Act came along. Look, we are not here to villainize these people. The fact is they take risks on your behalf. Sometimes these companies that they're invested in fail, and they need to spread their risk across multiple bets. But the VCs needed to understand that a new model was becoming available, one that was going after the very same investors that we're taking liquidity from, but the new model was giving investors like you and I the opportunity to directly invest in the company instead of through their fund. This meant competition. Up until 2012, VCs did not have to compete. The second most important reason, VCs never put the two and two together, that the consumer or the customer, you and I, could also be the investor directly into the company. Now, switching over to the issuer side, the company that's doing the fundraising, it was also a tough sell when Oscar went to them and said, hey, we're building an infrastructure that is going to allow a company to manage millions of privately held shareholders. You see, in that time, it was very costly for companies to fundraise directly, even with only 10,000 shareholders. The cost comes from the duplication of efforts. As a company, you bring your security issuance and your fundraising package to your lawyer. And then the lawyer assesses it and says, okay, done here, on to the next. So you take that same package to the auditor, another required regulated participant. And the auditor says, well, this is great, and we need all this info, but we need it in a slightly different way because we have different rules and procedures. This same redundancy goes on and on and on, all the way down the line of all the regulated participants, and there are a lot of them. Why? Because each of these small entities were not operating under a unified protocol. They were fragmented, and they could not trust each other enough to share data. So how does this impact the individual investor? Well, this might blow your mind, but let me give you an example. You purchased a security and now you want to sell it in 2012. You email the issuing company expressing your interest in selling. The company requests assessment and advice from their attorneys. They would assess it and then come back to you with guidance on how to sell your security. Back in that day, that process, along with finding a buyer to sell your security, could take as long as 6 to 9 months or longer. Mind-blowing, right? What was missing was a common infrastructure that all these disparate systems could glue together on in order to trust each other enough to share data, thus reducing time and cost. Another quick story. Over 55 years ago, a Canadian company created the infrastructure that was acquired by another company called Broadridge. Everything in the publicly traded world, over 100,000 plus traded companies and all its required regulated participants, sit on top of this infrastructure, and nothing moves without Broadridge seeing it. Now get this. In the US, there are 32 million privately held companies. There's 450 million worldwide, but coming back to the United States, 32 million privately held companies, and out of that, 145,000 private companies are raising capital every single year. And yet, until now, there has been no infrastructure gluing them all together, just like is happening on Wall Street. So why didn't Broadridge or some other big technology provider go and build what they already had for the public markets, but for the private markets? The answer is the markets don't operate the same. So it's not a plug-and-play solution. Everyone wants their own individuality, so until recently, it's been largely ignored. Well, due to the innovation and developments of the Jobs Act and other types of technology like distributed ledger technology, this has recently changed. To accomplish this effective result, Oscar Joffrey, David Wield as an advisor to him and his company, and the team built a solution under a company called CoreConnex. In the layer 1 of the company CoreConnex, they leveraged distributed ledger technology, also known as blockchain. But on layer 2, which is also known as the application layer, you would need various components. On that application layer, you would need all the different feature sets that allow a company to transact, that allow a broker-dealer to stay compliant, and allow for an investor to have all the communications they need to track and monitor their investments. You would also need applications for all the other intermediaries in the regulated process, such as lawyers, auditors, SEC transfer agents, and so on. There is only one securities regulator in the world that has its own secret police that is leveraged to arrest people and freeze assets on both domestic and foreign soil. So, for CoreConnex, it was really important to get guidance and a blessing from that type of regulator. That regulator is the SEC, They walked through the front door, sought guidance, and got the blessing of the SEC for a permissioned blockchain platform. And this allowed all necessary participants in a regulated process to come together under a common infrastructure. Now, all the participants can rely on the data, and the investors, you and I, know that when we receive a security, it's from a regulated SEC transfer agent. And they know that all the data is something that they can trust. And so I can now just sell a security just like I would in a venue like Coinbase. This is really the efforts and the story of how CoreConnex became the world's first SEC qualified blockchain platform. The value of their solution is trust. Now, how does this differ in something like settlement time when compared to the public markets? Today, there's an organization such as the DTCC. They provide infrastructure to the NASDAQ, and in those public markets, they are trading and settling in what's called T3 or T4. That just means that the trade gets settled in 3 to 4 days after the initial transaction. CoreConnex differs by having one of their nodes operated and managed by the SEC. A node for non-crypto or blockchain native people is just a computer or a server that is running the application of CoreChain. And so the SEC actually holds and operates one of these nodes. And the hashes that get transacted on these nodes represent an actual stock certificate. So, from one wallet to another, the investors, you and I, benefit from T0. That's instant settlement. And the SEC benefits from having all the background information they need about an investment in real time. You see, this was not even feasible for us back in the day. Back in the day, an institutional investor would draft an agreement with the lawyers for a price to sell the security. Then they would have to send it to their escrow and other regulated participants. And for individuals like you and I, it's not really feasible because in that case, we would have to retain an attorney and a broker-dealer. And the cost that we would incur for retaining those two entities while waiting for the process that, again, could have taken several months would outweigh the profit that we might make from the sale itself. CoreConnex eliminates all of this inside of an alternative trading system. The lawyers, the auditors, the broker-dealers, the SEC transfer agents, all coming together, trusting each other to create an uber streamlined process. So the public markets have Wall Street, the private markets have this new uber streamlined platform, finally. You see, what most people don't understand is that 33% of the global GDP is represented by public companies. But, interestingly enough, that leaves 66% of the global GDP to be represented by private companies. And up until recently, they never had a venue like the Wall Street like they do now. However, this new development in equity crowdfunding doesn't come without its challenges. So let's quickly discuss what those challenges are and how they're being met to derive new opportunities. Here are the facts. We now have an opportunity due to legislation and new technologies for upwards of 4.5 billion people to participate in private market investing. David Wield, the author of the Jobs Act and advisor to CoreConnex, expected this massive influx to happen. And he also wrote and expected how this would eventually crumble under the Achilles heel of private equity crowdfunding. Those heels are banking and media. Let's discuss those two challenges now. Imagine this scenario. Hollywood decided to take from the concept of the show America's Got Talent and fuse it with a show like Shark Tank. And they essentially had companies pitch to every American across the country live on their television sets trying to fundraise. If that were to happen, it would collapse the infrastructure. Not because of the front end, not because of the broker-dealers. It would happen because the banks would fail. Let me explain. The banking systems are so antiquated that when investors deposit money into an investment, the responsibility of the broker-dealer is to match the dollar amount invested with the money in the bank. And to do it, they have to do it effectively before the money gets released to the company and before the security gets released to the investor. This reconciliation process is a problem. There is good news. Hold on to your hats, because companies and platforms like CoreConnex have stated that they believe they solved this problem. And soon announcements will be coming out on that solution that I'll be really excited to understand and announce to my audience here. Now, the other biggest problem and the massive influx that private equity crowdfunding will have is media. Let me explain. We take this for granted because of our use of the internet. But as an example, imagine a person in Bulgaria wants to go and check the Tesla stock price. He texts his American friend and his Australian friend, and they all individually log into their own types of apps. But within seconds, all three of them have the same info: the CEO of the company's headquarter address, the news reports, the stock prices, etc. And you'll say, yeah, Hunter, that's simple. That's just the internet. But you would be wrong. You see, to even read about a public company that you can invest in today, you would be leveraging one of four major newswire providers, such as Yahoo Finance. These are regulated gatekeepers, ensuring that only real and approved news make it to your fingertips. But if you're a private company, that wasn't available until recently. You see, you might have even made the mistake as a private company to say, oh, okay, well, this is the process I have to do. So let me go pay $3,600 to Yahoo Finance or some newswire provider, submit my news, and then eventually complete that process, only to be dismayed when I go to search my company on Yahoo Finance and not find it. This was happening because the media was not allowed to actually publish the private company's news because of the risk involved. The challenge of the media is being solved by CoreConnex, because CoreConnex is again enabling trust. And so from day one, a private company decides they want to raise capital. It gets published on the core chain infrastructure. And because the SEC manages and operates one of the nodes from that infrastructure, they get data in real time, and they issue a unique identifier to the company, going on down the line of all the other regulated participants, such as verifications from the broker-dealers and so on, and that eventually makes it down to the newswire providers, allowing private companies to give access to information to investors so they can directly invest. This is insane. I mean, I hope that you're entertained by now, but if not, I want to add a few more layers of incredible opportunity. Firstly, to bring more credibility to CoreConnex, the world's SEC-qualified blockchain platform that is essentially acting like the Broadridge to the Wall Street, now a new infrastructure for Main Street. CoreConnex has the 5th largest company in the world for credit card and payment systems integrated into their platform called Nuvi, allowing them to participate in over 160 countries with different payment rails and not be excluded from any company. CoreConnex also has over 1.2 million privately held shareholders active in just one of their clients. They also have 3 alternative trading systems glued to their infrastructure today. Additionally, the Senate has just approved something that will give private companies an even greater ability to raise more money, up to $150 million annually. This is huge, and Wall Street is simply not ready. They are now having to learn to engage with the regular person and not just some hedge fund rep. Here's where the real fun begins. CoreConnex has only partnered with a very few amount of companies, one of which is another company that we talk about here on this channel. CrowdPoint Technologies is a digital platform provider, and they have built a decentralized cloud that leverages a decentralized ledger database, collapsing the ledger and database into one, leading to the fact that you're not just having immutable and transparent representations of the data, but you're actually having immutable and transparent data stored in a decentralized database. Now that's a lot of fancy technological talk, but let me let you know what that actually means. It allows them to offer a next generation business ecosystem that places the human identity as the North Star. Let me explain. Today, companies track your browsing behaviors, your online purchases, your phone location, the stores you enter, for how long you stay in those stores and what you purchase, and much, much more. They aggregate all this data and combine it with other similar profiles that have similar socioeconomic classes, geographic locations, etc., and they sell it to the highest bidders who then advertise to you. What's the big idea then? CrowdPoint Technologies platform protects your data and pays you when you contribute it. Think of yourself as a stock or a commodity. The value of you can go up based on the data that you choose to upload into your personal vault. And if and when you choose to share your data, the company accessing it only gets to see things like purchase history or income range or whatever you decide to share, while your personal details like your name, your number, your email are all kept private. CrowdPoint's product suite includes identity, marketplaces, capital, and finance. This essentially enables a private ecosystem where you can own your data, have it protected, and monetize it. And by contributing your data in a safe way, you can earn money. And with your new passively earned income, you can buy products and services from the marketplaces. Are you a business owner or are you interested in becoming one? Great, join their ecosystem and sell products or services as a distributor or a reseller. Additionally, you can take your passively earned income and invest in this new sort of private stock market that we've discussed. You can also earn extra income by referring others to buy products or invest in the private companies. You see, large hedge funds are already knocking on the door for guidance and ways to invest in the private companies that this ecosystem is onboarding. And that might make you think, well, Hunter, doesn't that mean that the big boys will eventually join too? Absolutely. Companies like JP Morgan Chase and Morgan Stanley will eventually build similar on-ramps like this too. But this is good. You see, no restaurant goes into business thinking that others will not pop up around them. They anticipate this effect, and it pulls in a larger customer base into the overall market when it happens. However, there are some notable advantages that are unique to CrowdPoint that I do want to point out. A quick recap. The partnerships of this ecosystem include CrowdPoint, the decentralized cloud and database platform. They provide cloud services, data storage services, and language model services to companies offering a safe and secure platform for your identity and the marketplaces and the financing and trading happening. Another key partner is CoreConnex, providing this all-in-one compliance platform that we've discussed. And last but not least, and more to come, a company called IVM, short for International Venture Markets, is the financing and trading arm of the CrowdPoint ecosystem, providing that private stock market partnership. So, what are these unique advantages? Firstly, the ecosystem understood where the customer was going, and they got there first. When we look at the history of innovation, it often pays to be first. Secondly, your identity is their North Star. This is a massive difference between traditional business ecosystems like Google's and Amazon's of the world. This is a massive difference of how they treat your data. They make you the owner of it. They protect and secure it and let you monetize it in a safe way. Thirdly, this private stock market restores the original grounding principles that the New York Stock Exchange was originally founded upon. In short, the New York Stock Exchange was originally a trusted environment using a revenue-only model and stabilized by a dollar set on a gold standard. Today, the markets have drifted away from this. Disparate technologies and centralized systems have corrupted the once trusted environment. This revenue-only model dissipated, leading to speculative reports and Federal Reserve policies that aid in the market manipulation. Finally, the US dollar is not backed by a hard asset. It is tied to an infinite money printing machine, which has devalued our currency, that gets further harmed by our country's debt accumulation. This next generation ecosystem has restored these original principles suited for the future. Their decentralized platform offers trust and security. Their markets return to a revenue-only model focused on the financial health of a company, removing speculative reports and the Fed from the picture. And lastly, they have instilled a digital dollar backed by silver. Now, let's separate the real from the fake. Some of you might hear the term digital dollar and immediately wince. Stick with me and let me put your fears to rest. The fact is the world and its money is almost completely digital already. The money in your bank account, even if deposited physically, is no longer there. It's converted digitally to some bond purchased by the bank. Additionally, some people hear the term digital dollar and conflate it with another term called CBDC. A CBDC is short for central banking digital currency. This is a currency issued by the central bank or the Federal Reserve, and it does have harmful implications that for the purpose of this video, we don't need to get into. But the main thing to note is that a CBDC can be a digital dollar, but a digital currency does not mean it is a CBDC. You see, if you've heard of a CBDC, then you've likely heard of cryptocurrency. Cryptocurrency is, in its nature, an evolution in money and asset representation, but it does not come without its flaws. We've seen that large sums of money and hype create fraud, and people come in and do things they shouldn't in the market. Crypto is great for securely representing assets or fractionalizing assets for greater access for investors and things like instant settlement. But it has been leveraged in frauds, Ponzi schemes, and money laundering. But let's not throw out the baby with the bathwater. Bottom line, does this ecosystem use cryptocurrency? No. It has taken the best parts of cryptocurrency and left out the aspects of fraud. How? This digital dollar used in this ecosystem is a regulated, SEC-filed security. It has a fixed supply, helping the asset drive more value. You're probably familiar with the laws of supply and demand. When there's a scarcity effect, more value comes to the asset. As a utility token, it benefits from additional utility, but it also benefits from instant settlement and fractionalization too. Lastly, this security is backed by silver, thus completing the restoration of the final principle the New York Stock Exchange was founded upon, a dollar backed by a hard asset. I've copied the links below so you can find the SEC filing for this token and a press release confirming their partnership with a silver mine for the collateralization of their asset with silver. But there is one final distinction I would like to make regarding this ecosystem when compared to traditional platforms and markets, and that is the team behind it. Oscar Joffrey, CEO of CoreConnex, we've already spoke a bit about. However, Sean Brim, the CEO of Crowdfunding, as a former military officer, spending time in special forces, doing things like cybersecurity and big data analytics, he was eventually building data warehouse models at IBM Watson for the CIA, aiding counterterrorism efforts, taking in massive amounts of data from global social media use, running analytics, and finding bad guys, a true patriot. And he knows, if anyone, how to build a secure platform. As an entrepreneur, he also built 2 successful companies, one of which was actually acquired by IBM, and so CrowdPoint is his 3rd rodeo. Nadeem Akhtar is also the president of CrowdPoint. He himself has moved over $8 billion worth of mergers and acquisitions on Wall Street. He knows finance. Dr. Wolf Cohn, another part of the senior management there at CrowdPoint, is an AI luminary, developing quant models. Previously, quant models and trading bots that were used by companies like Citibank that traded for almost 9 years through the 2008 banking crisis, earning somewhere between $2 and $4 billion per month. He brings these models and other more optimized models into this CrowdPoint ecosystem. Additionally, he brings proprietary design for what's considered a microgrid distributed intelligent control and management system. This solution features a control which monitors anomalies and stored energy power, finding patterns in past behavior and in real time, and then accurately distributing power based on the unique needs of the building it supports. Let me paint a real-world example for that. Let's say you and your family are going on vacation for 3 weeks. At this point, if you have solar panels on your home, you'll have stored power that you could sell for pennies on the dollar to the energy provider. But now you could bring that to the marketplace and arbitrage a price that works for you. Additionally, you have a CTO of CrowdPoint named Daniel Guinan. He was originally responsible for bringing online transactions, some of the first, to massive banks like Wells Fargo, eventually going on into his career to work for a small little company called Sun Microsystems. That company in 2016 was acquired by one of the most profitable companies in the world, Oracle. Why? Well, for many aspects, but namely one of them is because Sun Microsystems developed Java, one of the most widely used programming languages and frameworks in the world today. Within that effort, Daniel Guinan led a team to innovate and build Java Commerce, part of the Java framework, and in that commerce shop, they developed Java Card. And if you remove smartphones and desktops from the picture, Java Card became one of the most ubiquitous computing devices on the planet today. Additionally, you have someone like Jeff Hummel, CEO of IBM, the trading and financing arm of the Crowdfunding ecosystem, who brought in successful trading desk technologies from a company called Algotech Systems, which hosts 500,000 users and millions of dollars of individual investments. I mention these things to say this. This ecosystem is not a dream. It's been built, tested, and it has acquired key customers and partners and is producing revenue today. Early adopters are already experiencing the benefits and first-come opportunities with many more to come. Banks, companies across various industries, and over 1,000 individual participants and distributors are already on board. I've copied other relevant press releases for your reference, but in conclusion, I can only present this information. You must address, assess, and validate it for yourself. This ecosystem has built a well-positioned powerhouse blessed by the regulators to provide massive opportunities, especially for early adopters. So, join us on weekly calls hosted by IVM, the private stock market component of this entire ecosystem, every single Thursday at 5:30 p.m. Central, with hundreds of others looking to learn more about the future of investing, getting paid for your data, and opportunities at making money while you sleep. Please subscribe to the channel for more videos like this. Follow me on TikTok at Digital Oil Hunter, and I look forward to seeing more of you soon. Take care.